Meantime, markets are cheering. As we said, another lower than expected inflation report this morning. Our senior economics reporter, Steve Leisman, has more on today's PPI. Now, what it means for the Fed. Hey, Steve.
Hey, good morning, Carl. Yeah, the inflation data in the past week going 2 for 2. That is coming below expectations, capped by this morning's beat on wholesale prices. Could point the way to better consumer inflation numbers down the road and perhaps less Fed tightening ultimately. The headline producer price index coming in just at 0.2. That's half the expectations. Take out food and energy. It was unchanged that compared to a 0.3 estimate. We also had revisions downward to September 0.2 and 0.1 on the headline and core. The year-over-year rates for both headline and core, as far as the Fed's concerned, they remain far too high, but they have been marching down at 8%. The headline number is the lowest since July at 6.6. The core, the lowest since May. Both have now, you can see in that chart, been declining for several months, going in the right direction. What helped the PPI were declines in shipping costs and wholesale and retail margins. That's a conversation regarding stocks we may have. A decline in intermediate goods. That's further up the pipeline, suggests more disinflation to come. The question being whether retailers pass along those prices to consumers. Fed officials, they've been insistent. They need to see several months of declining data to pause rate hikes. So this is maybe the start of counting those months, not anywhere near the end. And the market looks to be, I'd say, in sync with the Fed still having more work to do in raising the current funds rate. It's now pegged 3.25, 3.75 to 4%. Now they're seeing them going up towards 4.5%. Each positive inflation report we get right now doesn't do much to that front end. What it does do, it reduces the back end of the Fed having more work to do and raise rates considerably, not having to raise rates, that is, above 5%. So those chances go down. We're going to bring these questions tomorrow to San Francisco Fed President Mary Daly. We have an exclusive interview right here on Squawk on the Street. And I'll just tell you guys, Ian Shepardson from Pantheon saying this is the beginning of the great margin recompression. Back to you.
Okay, I'll bite. You just ended with it, and you touched on it earlier in your hit. Let's talk about what this does to stocks.
Well, look, stocks want lower. They want lower inflation. They want less Fed. But along the way, one of the things that has helped stocks along the way is higher margins. Prices have gone up. You had Fed Vice Chair Brainerd has talked about this idea that margins and profits are higher historically than they have been. And so one of the things that happens, prices come down, margins come down. So this becomes a sort of foot race between declining input costs on the back end for companies and then declining retail costs or prices to the consumer on the front end. So we'll see how companies manage that, how they manage their supply chain. We're listening carefully to folks like Walmart, Home Depot about the levels of their inventory. We did hear Walmart inventories have been coming down. That's a good thing. We'd like to see some of that excess inventory and therefore moving that inventory, those lower prices show up more in the consumer price index. That could flatter it down the road.
Yeah, we're going to talk more about Walmart in a moment. But
yeah.
Since you mentioned it, Steve, also interesting, though, grocery was a lot of the growth there. They're gaining share. They also say people who earn over $100,000 are a key part of that gain. Not sure what your thoughts are about that. And then they're seeing people not necessarily trade down, but go for the private label as well in grocery. It's as you point out, it's an interesting reflection of sort of the economic times when you look at the Walmart customer and what they're choosing to do.
Yeah, and that's a third part of the dynamic for the retailer, right? Which is all of this happening against a backdrop of a slowing economy. Employment remains firm. Wages remain firm. That's a good thing for them. It should keep up sales on the front end. On the other hand, you have things like those who can. David, I was struck several years ago. I was looking at this inflation story. And remember, one of the things for poorer people is they can't trade down anymore. They're already at ostensibly the lowest possible price, or they're already at the private label brand. So that's why it hurts poor people and low-income people more. Inflation does more than it does wealthy people who have that opportunity to trade down. They'll do that for a while. And if prices stabilize and you start to see like there's a bargain to go upscale, then people will do it again.
All right, Steve Leisman, thank you.
Pleasure.
It's a good way to tee up our next guest, where we are continuing to focus on retail. Walmart beating on the top and bottom lines, also announcing a $20 billion share repurchase program. Home Depot also beating, reaffirming its full-year earnings forecast. With us now, D.A. Davidson retail analyst Michael Baker. Michael, great to have you on. I want to get your thoughts on this conversation we were just having with Steve and how it's playing out, whether it's this idea of margin compression as inflation begins to come off, whether it's this idea of the consumer mix shifting and fueling growth at a name in grocery at a name like Walmart. Your thoughts on what we're seeing play out from a macro level, on the micro level, through the retail results we've gotten so far?
Well, sure, yeah, and I think the highlight of the day is certainly Walmart, and we think their ability to take market share, particularly with higher end customers, and that is a function of somewhat distressing economic environment that we're heading into, and it is forcing customers to think about where they shop differently, and Walmart is well positioned to take care of that. The most important thing we saw today, I think, was their inventory levels come back, really cut in half, up only 12% versus 25% last quarter. And that's really what I think is going to be the key throughout the earnings season, is taking a look at those inventory levels. Up 12% versus sales up closer to 9%. It's not really too much of a glut anymore. They've really done a great job working that down. To the question about margins and how that plays out next year, I think that is a key question, and the idea of will retailers be able to hang on to prices as some costs come down. Both Walmart and Home Depot were asked that on their conference calls, which just ended, and neither are really being overly bullish or getting too far ahead of themselves in terms of predicting better margins next year. And I think that makes sense. You don't want to be out there saying that you're going to hold on to higher prices even as some input costs come down. But we do think it could be a little bit of a margin benefit next year relative to the big drag that we've seen in retail margins this year.
Interesting. Let's dig into Home Depot a little more right now, because we have seen the housing market soften and soften aggressively. Is that a forward-looking indicator for activity at Home Depot? Or if you have more people staying put in their homes because interest rates have risen as much as they have over the past year, is it a beneficiary?
Yeah, sure. Well, I think Home Depot's done amazingly well in this environment, which does seem to point to some slowing demand in that category. So we give them all the credit in the world. And I do think that as people stay in place a little bit more, that could help business. But in general, home price appreciation is the most important metric. Home prices are up certainly, about 40% in the last 3 years, but those increases are starting to moderate. We think the bar is just set a little bit higher here for Home Depot, given the Fed backdrop, which is still a little bit of a headwind. And so they had great results, but it's tough for that stock to work here as long